Two people turn 22 on the same day with the exact same $10,000 saved up. One puts it into real estate, the other puts it into the stock market. 30 years later, their bank accounts tell two very different stories, but their lives look even more different than their numbers. Meet Wealth Cat. Today we're following two people, Maya and Ryan, from age 22 to age 50. To see exactly what each path really looks like, Maya chooses real estate. Ryan chooses the stock market. Same starting point, same income, completely different journey. Let's start at the very beginning. Age 22, $10,000, and one decision that shapes the next 30 years. Maya, age 22, has $10,000 saved from her first job. She starts researching how to buy her first rental property. Ryan, age 22, has the same $10,000. He opens a brokerage account and puts it straight into a low-cost S&P 500 index fund. By 25, Maya has saved another $15,000. Combined with her original $10,000, she uses it as a down payment on a $150,000 duplex. The bank covers the rest through a mortgage. Maya now controls a $150,000 asset, using only $25,000 of her own money. That's leverage. Ryan, at 25, keeps contributing $500 a month into his index fund, on top of his original investment. Steady, automatic, no debt involved. Two completely different mechanics. Maya is borrowing to grow faster. Ryan is compounding slowly, without ever owing anyone money. By 27, Maya's tenants are paying rent that covers her mortgage, and the property has appreciated to $175,000 because she only put in $25,000. That $25,000 gain represents a 100% return on her original investment, leverage amplifying her upside. Ryan's portfolio, meanwhile, has grown to about $32,000 through steady contributions and market growth. No debt, no tenants, no drama. Both are winning. They're just winning in completely different ways. At 30, reality hits Maya. Her unit sits vacant for 3 months, and the roof needs an unexpected $8,000 repair. For a few months, she's paying the mortgage out of pocket. Leverage cuts both ways when the cash flow disappears. That same year, the stock market drops 35%. Ryan watches his portfolio fall from $60,000 to under $40,000 almost overnight. Ryan doesn't sell. He keeps his $500 a month going, buying more shares at lower prices. Uncomfortable, but exactly what the math rewards. By 33, Maya has refilled her reserves and used built-up equity to buy a second property for $180,000. She now manages 2 properties. More cash flow, but also more tenants, more repairs, and more weekends spent on phone calls. Ryan's portfolio has fully recovered from the crash and grown past $95,000. The shares he bought during the downturn are now worth far more. Neither path was easy. Both required staying in the game through the uncomfortable part. At 35, Maya's 2 properties are worth a combined $420,000. With about $220,000 in real equity after the mortgages. Her monthly cash flow after expenses is now around $1,200, money that lands in her account whether she works that month or not. Ryan's portfolio crosses $220,000, almost matching Maya's equity, with 0 debt and 0 maintenance calls. At this exact point in the story, both paths are worth roughly the same amount, just structured completely differently. At 38, Maya's weekends often involve tenant issues, contractor calls, and property walkthroughs. Real estate takes time, not just money. In exchange, she has monthly cash flow, tax advantages, and a growing asset base that appreciates while tenants pay down her debt. Ryan, at 38, has almost none of that time cost. His investment requires no phone calls, no repairs, no 2 a.m. emergencies, but he also has no monthly income from it. His wealth is only accessible if he sells shares, unlike Maya's monthly rent checks. By 40, Maya buys a third property. Her portfolio, now worth around $650,000, carries about $300,000 in equity. Ryan's portfolio, boosted by consistent contributions and market growth, reaches roughly $420,000, fully liquid, fully passive. By 45, Maya's equity has grown to about $480,000 as her mortgages get paid down and property values rise. Ryan's portfolio, compounding quietly in the background, climbs to roughly $650,000 by the same age. At 50, Maya's real estate portfolio, equity plus 30 years of collected cash flow, totals close to $850,000. Ryan's stock portfolio, at 50, sits at approximately $900,000, every dollar liquid and instantly accessible. Zoom out, and the pattern is unmistakable. $10,000 at 22 became close to $900,000 for both of them by 50. Through two completely different roads, Maya's path demanded time, tenants, and tolerance for debt. Ryan's path demanded patience, discipline, and the nerve to not sell during the crash. The winning move wasn't the asset, it was staying in long enough for either one to work.